Have we sold off enough? Do you think some of these areas of the market, particularly technology, have corrected to points where we are seeing okay value at this point, or is there more selling to come?
I think there is more selling to come, probably in more economically sensitive areas and cyclical areas as sort of economies slow down and sort of earnings weaken. I think in technology, clearly, it's been a lot harder affected than other sections of the market. The Nasdaq's down 27% this year. And actually, there's whole swathes of companies in the Nasdaq or the Nasdaq 100 that are down over 50%. And so I think you've seen a lot of that pain already. And I think what you have started to see in the last couple of weeks is as bond yields have come in slightly and come down, that has been relatively supportive for technology. And so, there is a narrative out there that if you continue to see, growth under pressure, bond yields starting to come in, especially at the long end of the curve, then this is probably quite conducive for technology valuations. Again, tech is clearly a broad sector, but clearly some of those companies are probably pretty resilient from an earnings perspective as well. And so I think the stage is set to see potentially a little bit more stability in some of the price action in these technology names over the coming months.
Daniel, last year, if you look at some of the markets in Europe, basically everything went up. Some went up more than others. But this year, if you look at, say, the French market versus the FTSE, you've had very choppy action on the FTSE, but only slightly weaker versus what still could be a downward trend on the French market, given what we're seeing around this energy crisis. Is there a split now in thinking, do you think, between the FTSE with the commodity components versus, say, trading on European markets, which were actually more favourable markets in recent years for investors?
Yeah, I mean, that has been the key trade of the year. I mean, the FTSE 100 is only down, a percent or two this year because such a large portion of it is mining, oil and gas, and also lots of sort of dollar earners as well, which has clearly been beneficial. And European bourses have been a lot weaker this year. But I think that's sort of justifiable given the sorts of companies that they've got there, sort of maybe a little bit more cyclical and economically sensitive than the FTSE and sort of less commodity exposure. So there's definitely pockets of value opening up there compared to the FTSE 100. But I think, clearly what will be interesting in the second half of the FTSE is whether commodities, continue their downwards trend, which we've been in for the last 6 or 7 weeks. And if that's the case, and we continue to see pressure on metal prices and oil and maybe gas, then the FTSE 100 is likely to be one of the worst performing indices, I suspect, if we do see commodities continue to roll over.
Noted. And Daniel, any comments on Haleon coming to the market today, the split with GSK, what it means, the significance, given there's not been a lot of market activity this year for companies that encourage them to come to market or change their fortunes?
Yeah, I mean, look, it's great. It's the biggest listings in 10 years, I think, for the FTSE, so it's great to see. You always get a bit of sort of weird short-term price movement when you get demergers out, and some people want to sell, some people want to buy, some people want GSK, some people don't. So it will take a few days to settle down. But I think the overall message at the moment is people want defence. It's a very uncertain world, and they want some resilience within their portfolios. And I think Haleon meets a lot of that criteria. Yes, the debt is a little high, maybe compared to peers, but it's manageable. It's very cash flow sort of rich business. So no issues there. And so I suspect it will be pretty popular over the coming days and weeks as investors want that sort of exposure within portfolios at the moment.